that we do have an impending presidential election in the US. And as we talked about last week, our economy is directly tied to the US economy. And depending on who gets into power in the US, that's going to have a massive impact, I think, on the T-bills in the US and the bonds here. So who knows what's going to happen? You know, if you're a December 1st renewal or a January 1st renewal or even a February 1st renewal, now is the time to be locking in your rates. If rates come down, you're going to get the better rate. But if they go up, you're still going to get the best rate.
Welcome to the Ottawa Real Estate Podcast. Join your hosts, Paul Stevenson, David Warren, and Greg Campbell, as they explore the world of real estate and mortgages. From the heart of Canada's capital to markets nationwide, and even a little beyond. Get ready for expert insights and hot topics. Let's get started.
Hello and welcome back to the Ottawa Real Estate Podcast. My name is Paul Stevenson, and I am joined by producer Steve today. It's just the two of us. Dave's in transit, Greg is in transit, and I'm here at my desk for all of you, bringing you the latest and greatest in Ottawa real estate, news, mood boosts, you name it. Thank you for tuning in. And a happy belated Thanksgiving weekend. I hope everyone had a great time with friends, loved ones. Got lots of turkey in you. I definitely am feeling it today. Couple too many glasses of wine, couple too much turkey, and couple days of too much turkey. And I'm going to need a few extra walks, a few extra runs this week. But I'm in the saddle. The horse isn't happy, but I'm in the saddle. So I'll start with a quick market update. I'll get into some news. And then, as always, I'll close it out with a definition and some mood boosts. So market update, Greg gave me a couple pointers as to what he's seeing. And I'll give you some things that I'm seeing as well on the mortgage side. So as far as the market goes, Greg's saying that prices seem to be stabilizing or actually reducing overall as buyers are kind of waiting for that impending rate drop on October 23rd. And I'm going to touch on the rate drop quickly because for me, I hear this literally daily from clients. Rates are coming down. We're just waiting for rates to drop. What's happening with rates? We've heard that rates, like literally everything is about rates coming down. I think it's so important for people to understand that the Bank of Canada's rate announcement only directly impacts variable rates. And the majority of clients, I would say probably 80 to 90% of clients over the last 5 years, probably 3 years for sure, have been fixed rate clients. But I think the understanding of people is they hear of or they see the headlines saying rates are dropping, rates are coming down, Bank of Canada's dropping rates, and they just make the assumption that it's fixed rates as well. Now, fixed rates are indirectly impacted by the Bank of Canada's decisions. The fixed rates are impacted by the Government of Canada 5-year bonds or bonds in general. And I apologize if you listen every week. This is probably very redundant, but I think it's so important for people to understand this. The fixed rates are connected with the bonds, and the variable rates are connected with the overnight lending rate, which impacts the prime rate, which impacts variable rates. Now, the bond rates are impacted by the Bank of Canada's decisions, but it's one of 8 to 10 other things that impact it. As we saw last week, the job numbers came out in the U.S. They were stronger than they anticipated, which drove up the 10-year Treasury bill, which drove up our bonds, which drove up fixed rates. So all this talk about fixed rates coming down, people waiting for fixed rates to come down, they went up last week. So bizarro world, it's not as clear. It's as clear as mud, as they say. There's no rhyme, there's no reason at times for these things to happen, and you have to, when you have the opportunity, lock that rate in, and don't be greedy, I guess, is the end of the story, because I've seen some people that were at 4.29 somewhere in that range, and we're still kind of waiting for rates to drop. Now, luckily, those rates are locked in, so if rates go up, they're not subject to that, but they're still anticipating the rates are going to come down even further. I had conversations last week, a lot of conversations recently with people renewing in November 1st, November 2nd, and they're hoping to wait until after the October 23rd date to lock in the rate. And I'm telling them, that's just not an option. Typically, lenders want you to be completely what we call broker complete. So, conditions fulfilled, documents signed, etc., at minimum 10 business days before your set closing date. So if it's November 1st, we're talking, the 23rd, 22nd of October is when everything needs to be done, even earlier, 20th, because we're talking business days. So the 23rd is not, that even if the rates do come down, which I anticipate probably a quarter point, then we're going to see the reflection of that probably on variable rates. It'll be as soon, like basically the next day. But for fixed rates, we might not see it for a week or two. And the other main thing to keep in mind here is that we do have an impending presidential election in the US. And as we talked about last week, our economy is directly tied to the US economy. And depending on who gets into power in the US, that's going to have a massive impact, I think, on the T-bills in the US and the bonds here. So who knows what's going to happen? If you're a December 1st renewal or a January 1st renewal or even a February 1st renewal, now is the time to be locking in your rates. If rates come down, you're going to get the better rate. But if they go up, you're still going to get the best rate, at least the rate that you've locked in at. If you wait to see what happens and rates go up, you're subject to those rates. There's no way to backtrack. There's no crystal ball, as we say, but there's also no time machine. So you can't go back and get the rates you wanted a month ago because rates have gone up. So that's my short rant on rates. Greg was saying showings on most properties that would otherwise sell quickly have slowed or stopped in recent weeks. He said it's a stalemate between buyers and sellers. More vacant homes are available, and sellers are ready to negotiate. Fixed rates have remained steady in the mid fours right now. We're seeing kind of 4.49 to 4.59 right now for an insured purchase on a 5-year fixed. And those who locked in the low fours are definitely feeling pretty content right now, I would expect. And yeah, it's just rates are obviously front of mind for everyone, especially with, us seeing, and I have an article actually about economic inequality later in the episode, but I think it all speaks to that. People that did lock in a rate a few years ago when they were in the 2s, 3s, they're feeling pretty good right now. But as we know, there's a lot of renewals coming up in the next 12 to 24 months. And where those rates are going to land is anyone's guess. So the sooner you can start having those conversations, most lenders will allow you to start looking at rates, 4 months out from your renewal date. So that 120th day before your renewal, start the conversation. Even start it before that, 125 days, 126 days. Get a week's advance notice so you can actually get a rate locked in as soon as possible. And as I said, on the broker side for David and I, as the rates come down, we can actually float that rate down, we call it. But if the rates go up, you're still going to be guaranteed the rate that you lock in at. So it's kind of a win-win in that sense. I'm going to jump into it, Steve. Why don't we get into the news? Into the news. Feels so good. I feel like I need like a green screen behind me here with some, some stock ticker symbols. So I got 3 articles to go over today, and I'll go through them, at a fair clip. But the first one's about income inequality. This is from Better Dwelling. So I'll summarize it here. It says, Canada's income inequality has reached a record high, with the gap between the wealthiest and poorest households now wider than ever, according to Stats Canada. The disposable income disparity between the top and bottom 40% of households has surged to 47% in 2024, reversing decades of progress in just 4 years. Factors include the wealthier benefiting from low interest rates, while low-income households struggle. With such stark income inequality, will Canada's housing and economic policies exacerbate this trend further, or is this a path to closing the gap? So, very interesting, not surprising. I mean, rising, inequality worsens housing affordability in Canada because the wealthier individuals can afford to buy properties more easily, which drives up demand, which drives up prices, and lower income households struggle to save for the down payment and to qualify for mortgages. So we've seen recent policy changes to try to help that, extending the amortizations for first-time buyers, increasing the insurable mortgage cap. But right now, with this inequality, it leads to kind of widening the gap between renters and homeowners, and that makes home ownership less attainable for many, and seems like an increasing amount. Now, the lower interest rates that we saw, as I was mentioning, over the last 5 years has contributed to the wealth gap by making borrowing cheaper, which allows affluent individuals to invest more into real estate and other assets. So this boosts their wealth even further, and those without those assets benefit last, which, as it says, actually exacerbates the inequality. So that gap widens. Now, what is the solution to this? I don't know. Not my expertise. I feel like this is where, our politicians and our government needs to at least put forward ideas and concepts, and I think they're trying to do that right now. It's disappointing to see it get to this point before they step in and start making these changes. Some of the changes that they're making now were proposed years ago to try to avoid this further inequality. But we're at a point now where it's gotten so bad that they have to implement these changes quickly because the inequality is just becoming quite large. Speaking of large, second article was regarding the TD Bank fine. So if anyone has had the TV on in the last 7 days, you would have heard of the massive fine that TD Bank is dealing with. So TD Bank was hit with a record $3 billion, that's a B, bubba, $3 billion fine by U.S. regulators for failing to adequately monitor money laundering activities connected to drug cartels. The bank's systematic issues allowed over $670 million to flow through accounts, facilitating illegal activity. Attorney General Merrick Garland criticized TD for prioritizing profit over compliance. The bank's CEO apologized and pledged reforms, including hiring more anti-money laundering specialists. With U.S. growth restrictions imposed, TD's future growth plans are now uncertain. And they asked the question, could these penalties reshape TD Bank's global reputation? Personally, I don't think it's going to do anything. Like these days, I feel like it's 1 billion, 2 billion, 100 billion. People, like the next day, the news cycle's so fast, people forget about this. Like this is already, it hasn't even been a week. I feel like this is already old news. Like, we had to report on it the day of. Anyone who banks with TD, I bank with TD. This doesn't change anything for me as far as, as long as my money's there and it's available and my accounts are fine. Like as far as direct impact, it doesn't change. Like, personally, and maybe this is bad to say, but I feel like most of the banks are operating in some form of fashion like this. The amount of hoops we have to jump through on our side from a regulatory standpoint is insane. Now, I think that's a good thing. Certainly not complaining about it, but the fact that this can still happen at the banking level with all of this due diligence being done, I think also speaks to the intelligence and the advancement of the people that are committing this fraud. Now, in this case, they're saying it was a systematic error, so something within their kind of internal compliance that was insufficient. So, how can they balance growth with legal compliance? That's the biggest question, because is this going to hurt them long term? I don't believe so, but how can they make sure it doesn't happen again? And also, like, what can you do? You're not going to close down these, like if you just close down TD, okay, we're fining, we're basically shutting you down. It can't happen. And they obviously know this, I would imagine. So, these things happen. They get a slap on the wrist, a large $3 billion slap on the wrist, and they try to not do it in the future. But while all this was happening, what was the benefit, I guess, on the bank side? And in dealing with these cartels, I mean, certainly not going to knock on the cartels on air, but you have to imagine that there's more to the story here that we're obviously not hearing about. Now, banks can prioritize a strong compliance culture. I think that's one thing that is very important. And we've seen, I mean, I've worked in the banks and I know that the compliance is through the roof. So these things happening to me is wild that it can even happen because of the steps that we had to take at the banking level, at the retail banking level to adhere to compliance. Investing in technology for better monitoring is obviously an easy solution, especially with all the AI tech and stuff we have now. Conducting frequent audits. I mean, these are things that I think are obviously happening. So again, how these things happen is beyond me. Should the penalties be harsher for banks to prevent such violations? Harsher penalties, in my opinion, could deter misconduct. It holds them more accountable for regulatory breaches. However, excessive fines might actually harm economic stability. So, striking the right balance is crucial. Ensuring penalties serve as a corrective, but not a punitive blow to the financial system. Because here's the thing. These sorts of stories, you would think erodes trust in the financial institutions themselves. But really, what options do you have? If you don't trust the bank, where else, where are you going to put your money? You can't put it in the shoebox. I mean, you can, but that you're going to run into your own issues by doing so. So, on our side, we really don't have much choice. We have to utilize these institutions. So, eroding trust is probably the worst thing that's going to happen to them. I think it can fuel organized crime, which we saw. I mean, this is the whole point of this, is it was fueling organized crime. And I think it also diverts resources from legitimate businesses. So, all this money that's going out the back door, I mean, this could be used or could be helped to fund legitimate businesses. And, I think it destabilizes economies. It allows illicit activities to thrive, as we've seen in the States for sure, which leads to higher crime rates, reduced tax revenues, damage to local economies, and yada, yada, yada. So there's a lot of negative kind of downspill to all of these things happening. And ultimately, us as the consumers are paying the ultimate price because it increases the cost of goods. It increases our banking fees because they need to recuperate some of these losses. So everyone loses really at the end of the day. And this leads me to the last article, which I think ties right into this, is another article from Better Dwelling. And the headline just says, Canada needs to prepare for bank runs, collapses, and a former regulator. So this says a former Canadian banking regulator has warned that the country should prepare for potential bank runs and collapses, despite the historically strong reputation of its banking system. The global interconnectedness of financial systems means that vulnerabilities abroad could impact Canadian institutions. The report recommends modernizing deposit insurance, strengthening liquidity facilities, and preparing for the failure of multiple banks simultaneously. Policymakers are urged to act now to prevent future taxpayer-funded bailouts and safeguard financial stability. Now, what happens if a bank in Canada failed? That's really, like, people kind of want to know that. We saw in the US in 2023, the Silicon Valley Bank collapsed in the US. Now, that was driven by a combination of poor risk management, a sudden run on deposits. So, sorry, I'm using kind of bank jargon, but bank runs is essentially when, let's say TD Bank has this announcement and everyone says, oh, shoot, TD Bank's going to go under. Myself, Stephen, Greg, Dave, everyone we know and their uncle goes to the bank and says, I want all my money. So basically taking out like massive withdrawals from the bank. That's what's called basically a bank run. So you're like large withdrawals all happening at once. Now, this isn't common. And for anyone who doesn't know, the bank obviously doesn't hold all of the money that they have in deposits is not available. Like if everyone goes to the bank and wants their money, like it's not happening. You try to go to the bank today and ask them for $15,000 in cash from your account. It's like, it's not happening. You can't do it. If you want, I think anything over 10,000, I believe now, they need days notice. Like you have to give them like a week's notice so that they can prepare it. So bank runs would be based everyone trying to withdraw those funds and the bank not being able to facilitate it. So what happens if a bank fails? So widespread economic consequences due to the central role banks play in the country's financial system. The government and regulatory bodies such as CDIC, so the Canada Deposit Insurance Corporation, would likely intervene to stabilize the system. So we saw, those are kind of the bailouts we saw in the US. Now this is Canada, so a bit different. But depositors, so in Canada, you're insured up to $100,000 per account. So if you have, let's say, a checking, a savings, and another, say, a high interest savings, each account is insured up to $100,000. So if you had, let's say, $1 million in the bank. Most people have $1 million, but let's just say $1 million in the bank in your checking account, which would be ridiculous. But if you did, you would only get 100,000 of that insured. So the rest of it would basically be lost if the bank failed. Now, potential bank runs, that's probably the most likely. So you have a bunch of negative news from a bunch of different banks. The likelihood is that people are going to try to withdraw their funds or transfer it elsewhere, transfer it out the country, whatever they try to do, transfer it outside of the country. But potential bank runs, disruptions in lending, mortgages, and everyday banking operations. So, when you make a deposit, if you have $100,000 in the bank and it's in a, 5-year GIC, the bank is then taking that money and lending it out as well. So if you're getting 2% on your GIC, the bank's lending that out at 5% on a 5-year mortgage. So they're making that spread between the deposit and the amount they're lending out. So if there's a bank run and people start taking out their deposits, then, that's going to impact lending, mortgages, loans, et cetera, et cetera, et cetera. So these are all things that could happen if if a bank in Canada failed. Oh my gosh, Stephen, I can't. This is the process. See, I get no breaks when it's just me, so my words start jumbling together,
Are you trying to grow your mortgage business? Centum has the tools and support to help you take your business to the next level. Get access to everything from free unlimited custom marketing to daily direct pay. Find out what your business can do with Centum. Learn more at joincentum.ca.
Are you thinking of buying or selling a residential property? Relationships are at the heart of every real estate transaction. At Geltin Poirier Avocats Lawyers, we love to bring residential buyers, sellers, agents, lenders, mortgage brokers, and the law together to close the deal for you. For an effortless client experience that opens doors, call us at 613-744-4488 or visit our website at geltinpoirierlaw.ca. Let's get to the heart of your deal.
So what proactive steps can you take to protect your savings? So obviously and this is not financial advice, I'm not your financial advisor or planner, but diversifying your savings is obviously the most obvious. Keeping within those insured limits, Staying informed about economic trends can really help safeguard your funds. Regularly reviewing your accounts and understanding the financial risks can also reduce exposure. So maybe it's diversifying among a few different banks and making sure that you understand the CDIC limits so that if a bank did fail, you don't have all your eggs in one basket. Switching gears here, Stephen, I wanted to quickly touch on a stat that I saw that was pretty surprising, but also ties directly in with a new announcement in the budget 2024. There was a stat I saw online. Steve Saretsky, who's great for info on Twitter, just at Steve Saretsky. He says Canada no longer builds single-family houses. Back in 2000, they used to account for 61% of total housing starts. Today, it's 23%. And there's actually a chart here that shows the total housing starts between single families and multis. So are single family homes dead? That's kind of the ultimate question here. I'm just going to read you an excerpt. This is directly from the Government of Canada's webpage. It says, many homeowners have extra space they want to convert into rental suites, such as an unused basement or a garage that could be converted into a laneway home. Historically, the cost of renovating combined with municipal red tape has made this both difficult and expensive. Recent municipal zoning reforms in Canada's major cities made possible through Housing Accelerator Fund agreements are creating new opportunities for homeowners to add additional suites and increase density. New rental suites will provide more homes for Canadians and could provide an important source of income for seniors continuing to age at home. In Budget 2024, the federal government announced its intentions to make targeted changes to mortgage insurance rules to encourage densification and enable homeowners to add more units to their homes. Today, the government is releasing details for lenders and insurers to offer this new insured mortgage refinancing product effective January 15th, 2025. So here's the parameters. Here's kind of the bullet points. So this message will apply to all borrowers seeking to access mortgage insurance in Canada to add more units. These borrowers must satisfy the following requirements. They have to already own the properties. The borrower or a close relative are occupying one of the current units. They intend to construct additional units, and the additional units must not be used as short-term rentals. So you can't use them as Airbnb. As we all know, Airbnb only applies to your primary home. These would not qualify for that. Now, how they're going to monitor that and how people are not going to do that, I don't know, but that's one of the rules. Refinancing, so insured refinancing will be allowed for the purpose of building additional units. Currently, if you refinance your property in Canada, so refinancing would be, I have a 5-year term, I'm 3 years in, I need to access some equity. I'm going to refinance my mortgage. So I'm basically restructuring the mortgage completely. I have to re-register it for a new amount on title. That typically would be uninsurable. So, CMHC, Sagen, et cetera, they're not going to insure that mortgage. Now with this new program, for the purpose of building additional units, you can refinance and it would be insurable. So the new units must be fully self-contained. For example, basement suites with separate entrances, laneway homes, et cetera, and meet municipal zoning requirements. The maximum of 4 dwelling units, including the existing unit. The as improved value of the eligible residential property against which the loan is secured must be less than $2 million. So you can go up to 90% of the property value. So 90% of $2 million is an obscene mortgage to have if you're refinancing, but that's what it is. So up to 90% of the property value, including the value added by the secondary suite. And the maximum amortization is going to be 30 years. So the rules for first-time home buyers are extending to 30 years. This is going to follow under that same thing. So CMHC is obviously looking to expand that insurable horizon, that amortization across the board. And it says additional financing must not exceed the project costs. So you can't just refinance 90% of $2 million, build a $100,000 unit, and then just walk off with another $600,000. It has to be for the sole purpose of basically financing that dwelling. So I think it's good. I think that the limits are extreme, but also, we're used to Ottawa market. If you're in Toronto and your home's worth, $3.5 million and your mortgage is already 1.2, I mean, I guess this is kind of the thresholds they need to have to be able to implement this. But that chart that Steve had up, not our Steve, but Steve Saretsky, shows that there is much less single family homes being built, lots of multis needed. And, with the rising population in Canada, we do need more units. I think the last we talked about this, only 23% of the housing starts in 2024 that were expected have actually started. Where a quarter of the homes that were supposed to have been built in 2024 have been built, or at least started. So, we're still lacking massive supply as far as being able to house people. So I think this is a good program. I think it's a good project. I think it will create opportunities. And, we have an aging population as well. So I think as the baby boomers are looking to downsize, having the opportunity to move into a brand new granny suite or some form of unit that's attached to a family member, I think is going to be very popular. I think that's going to be something that people seriously consider. And, it'll be interesting to see where this goes. I think it's one of the better programs they've come up with. The limits are something, but, opening up to 30 years, so long as you can afford it, I think with where things are, they kind of had to do this just to create more opportunities for people to at least get creative. The rules were so tight that, as I said, the red tape that's there has limited starts, like the permits, the builds, the cost it is to actually get a shovel in the ground is obscene. It's increasing year over year. So I think this allows people that are already established homeowners that maybe have the ability to afford to add these units can actually do so and create additional dwelling here in Canada. So I think it is a good program, and I was really happy to see that. But that actually I saw Steve's post, and then I kind of looked into it. I said, oh, this kind of relates directly to that new program they're creating. So what are your thoughts? I'm interested to hear how listeners feel about these changes and all these articles that we've been discussing. So definition, Steven. I'm going to slide into the definition here, and then we'll get into some mood boosts. Love it. That beat just hits you. So definition today is equity. Seems very simple, perhaps, to some, but I get asked this question all the time. So equity is the difference between the current market value of your property and the amount that's still owed on the mortgage. So home equity builds as you pay off your mortgage and as the property value increases. So there's always this conversation, this back and forth about, whether it's better to rent or buy, et cetera. The one thing to consider with buying is that even if your property appreciates nil, you're still getting the principal pay down. You're kind of getting a double benefit. You get the principal pay down on the mortgage, and you also get the increased value of the home. So, as we saw in 2019 to 21, people's property values increased massively, and with the low interest rates, they were able to pay down their mortgage even faster. So that equity grew a lot faster. In today's market, where rates are in the mid fours and home prices are kind of stagnant or even dropping, last year we saw them drop for sure. So people's equity was kind of getting squeezed, and anyone who put 5% down on a home in 2023, and you pay a 4% insurance premium, so you're starting your mortgage at 99% equity. If that property value goes down even slightly, you're over 100% what we call loan to value. So these are all things to keep in mind, but equity is kind of what everyone talks about. Oh, how much equity do you have? What's your, it all factors into your overall net worth and so on. So equity is, simply put, the difference between the market value of your home and what's left on your mortgage. So there you go. That's your definition for the day. And last but not least, I'm going to tell myself some jokes here. Steven, you're going to have to be my guinea pig today for the jokes. Let's get into the mood boost. So I got 3 today. First one is topical, a little late, but has to do with the celebration here we just had this weekend. So number 1, what's something usually insulting, but not at Thanksgiving? A family member giving you the bird.
That's fair.
I like that one. Number 2, why did the turkey bring a microphone? He was ready to roast. Right?
Yeah.
And number 3, this one's a little embarrassing. What did the turkey say to the computer? Google, Google.
Whoa.
That was a really bad turkey impression. Wow. That was fun. I don't know if I could do that every week, but nice little switch up. I don't know how that was 30 minutes. That seemed like it was 10. So if anyone made it to this point in the episode, thank you for your support. And I very much look forward to having Dave and or Greg back next week to join in on the conversation. But new episodes are released every Wednesday, 10 a.m. on YouTube and all streaming platforms. Make sure to check out our socials, follow us, comment, and be sure to share the episode. And we'll be back next week. I'll be back next week for sure. We'll see you guys then. Have a great week.